I'd like to introduce you to Kaitlin Byrne. Kaitlin has been in our business since 2015, and she started off as an equity analyst covering banking, consumer discretionary, and industrial stocks on both our Africa and SA equity capability. She is now portfolio manager on those same strategies and also has a number of qualifications behind her, including a CA as well as the CFA designation, also a UCT graduate. So over to you, Kaitlin, and she's going to tell us all about SA equity.
Morning, everyone. So this morning I'm going to talk to you about something close to home, is finding safety in South Africa. So if we just look at the news headlines every day, I think the negative news often overwhelms us. It feels like all we should do is take our money offshore, go somewhere safe, because there's just no hope for South Africa if you read the news headlines. And looking at these news headlines, the one thing they never really talk about is the valuations. So speaking to what's priced in and what's not priced in is one of the most important elements. So those news headlines actually help us. So they help say, actually, the market already knows about all of those facts and that information, and they've been able to price that in to the different markets. So where you really want to worry is where that information is unknown, where it hasn't had a chance to be priced in. If we look at the graph in front of you, you'll see we've got the S&P 500 in blue, the SA market in green, and the world market in the peach, and then the world ex-US in yellow. So you can see that the differential between the valuation of the US market and the South African market is at exceptionally stretched levels. And that makes sense in line of what we read in the news. So if you look at the FT or Wall Street Journal, everything is going right with the US. So despite interest rates that they haven't seen for a very long period in time, the consumer is still very resilient. The companies are still producing very good earnings growth. So it feels like there's not a lot which can break this US market. Whereas on the other hand, when we look at the South African market, we think, well, it's all just gone wrong. But actually, the market knows about that. And if you look at that South African price to book, it's at one of the lowest multiples that we've seen in a very, very long time. And so you can say a lot of what we can see has already been priced in. Whereas in the US, should there be any negative news which starts to come out, you can clearly see from this valuation that that hasn't been priced in yet. And that's where you really have to worry, because shareholder returns have a lot to do with your starting point on the valuation. It's going to be very difficult to make money from a very high starting point. One of the other attractive things about the SA market is there's this huge differential in valuations between different companies, which creates an excellent environment for active management. So what is difficult is a market where things are priced very closely. And so stock picking matters very little at the end of the day, because everything ends up giving you the same result. So this is one way we look at actually what are the opportunities in the equity market at the moment, by saying what is the difference between the most expensive quartile of stocks and the cheapest quartile of stocks based on their dividend yield. When that gap is very wide, it means you have a fairly big basket of cheap stocks and a basket of very expensive stocks, in which case active management gives you a lot of opportunities to still produce very good returns. One of the other misconceptions about the South African market is actually, where do the South African earnings and revenues come from? So when we think of the South African market, we think 100% of the revenues of the companies are coming from South Africa. But where we're very lucky in this market is that a lot of companies have diversified offshore over time. And so when you look at the makeup of the revenue of the companies listed on the stock exchange, you can see only 22% of the revenue is actually coming from South Africa. So yet the market has priced this market as though everything is doom and gloom. But we've got a market where the revenue is really well diversified. We're getting even portions of America, but at South African valuations. That provides a lot of safety in a market, is having very cheap valuations as your starting point. It almost provides a floor for you for the downside, and having a diverse set of revenue. So we're not, if things get worse in South Africa, actually it's only 22% of revenue coming from that market. Sometimes we look at the capped SWIX returns and we go, well, the market's going nowhere. If you look at what the market's done over the last year, it's hardly moved. And that's just because of South Africa being in a very dire place. But what you do is when you look into that composition of the capped SWIX, and you say, how did the top 10 stocks really move? And how did the bottom 10 stocks really move? And what you can see is there's been this huge divergence between returns. So you've got on the left-hand side the companies which underperformed year to date. So those are your companies in the PGM sector, and those have come off exceptionally high valuations. So again, speaking to that point of the starting valuation really matters. And then you look to the right-hand side, and actually you've got a lot of financials there and industrial stocks where their valuations were really low. And as the company has performed, so the stock has improved, just given the very cheap valuations. If we look at the same picture for the US market, it's not nearly as well spread out. So you've actually got a very high concentration of stocks which have accounted for nearly all the returns of that US market, which means putting money into an index fund or anything close to an index fund in the US, you're exposed to these companies which are trading at exceptionally high valuations, and everything needs to work out perfectly in order for that valuation to actually give you good future shareholder returns. What you'll also notice is, looking at some of these names, is they're all in a very similar sector. I mean, in the last year, if you've mentioned the word AI in your results call, your share price is instantly up. So we know now from a market perspective, we get a lot of safety in terms of that valuation and how diverse the market is. So I think we can tick those two boxes on the South Africa side. From a stock selection side, we can also do a lot of work in terms of how do we actually get a safe portfolio by looking at different factors. So starting from the bottom is what we want in a company is balance sheet strength. So I'm going to run through some examples just now of companies who've been able to really take advantage of balance sheet strength over the last few years where things have been difficult. The next thing is pricing power. So if we think of pricing power, we can think of companies like the retailers who at the moment have very little pricing power. And that often you might start in an industry where there is significant pricing power. As that industry matures, so that pricing power disappears. So you can see in an environment like today, you've got both clothing and food retailers who are struggling to pass on the full extent of that inflation because you do have a weak consumer. And you've got a very mature market where all your retailers are fighting to take market share from each other. So we want a business that has a competitive advantage that's actually able to continuously price in line with inflation, and you'll see that in the margins. So companies which have very stable margins usually have a good element of pricing power. But the overriding factor comes back to that valuation. So you could have a company which is exceptional. It's got stable, high margins, it's got great balance sheet. But if you're paying an exceptionally high price for it, you have got a higher probability of losing a lot of money rather than making good shareholder returns. So let's run through some examples of sectors or companies in South Africa which show this opportunity. So the banking sector in South Africa makes up a large portion of the index. And I suppose in this period where we've had rates rise over 400 basis points since 2021, it does create a number of red flags. You've always got to be cautious of the banking sector when you've been through a period of rapid and high interest rate increases. But the caveat to that is the loan growth leading up to that period. So what would have made the situation worse is if we'd had a very heated banking sector. So if we were going into this period where loan growth had been running over 20% a year, and then you get the rapid rate rise, that's where you've got to really worry. But here we've actually had banks who have been exceptionally conservative in terms of their lending. You've also had banks who have been very cautious on their balance sheets. So they've taken a high amount of provisions during COVID. You've also had IFRS 9 implemented in 2019, which ensured that the banks really shored up their balance sheet very well. So we're sitting in a position today where, of course, there is this risk of increased impairments coming through on the banks. But we think that the capital of the banks in South Africa are exceptionally well managed, and the market is well aware that the consumer is under pressure. So if we look at the graph on the left-hand side, you can see that despite the earnings continuing to grow from the benefit of these higher rates for banks, actually your market is already priced in the fact that your impairments are going to rise. And that provides an opportunity for us because we think, yes, there's good balance sheet strength, and we're getting it at a very good valuation. Taking a look at another company, Bidcorp. So for those of you who don't know Bidcorp, it's a food service company. So they essentially deliver food items to hotels, restaurants, prisons, hospitals, and they've got a global business. So if you look at the graph on the right, you can see their revenue comes from many different places across the globe. And what happened is, going into COVID, they had very little debt on their balance sheet. So if you look at the graph on the left-hand side, you'll see the green shows their net debt with the purple showing their market cap. So very little debt on balance sheet. As COVID broke out, this was obviously an industry which came under huge pressure with restaurants, hotels closing. You also have a lot of smaller players in this industry. And so during that period, in order to survive, the smaller players ended up closing a lot of capacity. They just didn't have the balance sheet to sustain it. But because of how Bidcorp had positioned themselves, they were able to actually expand capacity during this very tough time. And so as soon as the market started reopening, actually they gained huge amounts of market share. So this should be a business that doesn't necessarily have pricing power because you are just moving food items. It's a logistics company to a degree. But because you had this huge shortage of capacity, suddenly you were actually able to price to the extent of the food inflation that we've seen. And so you've been through this period where revenue has far exceeded everyone's thoughts, and you've been able to expand margin, which you can see in the turquoise line on the right-hand side. And then the last example being a bit of a peculiar one, because this is a company which didn't have a good balance sheet and has no pricing power. So Sun International, I'm sure a lot of you have heard of it, being a casino operator, has very little pricing power, and their balance sheet had been geared up significantly going into COVID. They had done large acquisitions. They'd done the recent build of the mainland main casino. And so going into COVID, the market essentially said, well, there's no hope for this company. So the valuation got down to levels so low that the market was actually saying there's no way this company can survive. Whereas the way the balance sheet was structured, there was actually quite a lot of optionality there. So because you had different businesses, you could sell and therefore use that cash to settle your debt. You could also cut back on capex because you've got hard assets. And essentially, they brought their debt down significantly more than people ever expected. And the EBITDA eventually recovered to normalized levels. And you can just see how the share price reacted as your earnings got back to normalized levels. So that's why I say that valuation piece is actually always the key part to safety, because it does provide you this underpin, a floor essentially, to your returns. So just in conclusion, I think we have all been through this very tough period in South Africa where we're all aware of the amounts of load shedding, the problems with Transnet, the corruption. And it does often feel like a place where there's very little returns available. But I think you've got to often step back and say, well, what is the valuation on offer here? There's a reason the market is this cheap. So on a forward PE basis, we're at one of the cheapest levels that we've seen in a very, very long time. And so any positive improvement from here has certainly not been priced into the market. And I think that's where your greatest opportunity really sits in investing in South African equities. If we look at the right-hand chart on the US market, you can see quite the opposite. You've had the dollar, so the dollar is the peach line, and you've had a very, very strong dollar, which has made it very difficult for all emerging markets, not just South Africa. And you've also got a market which is expensive. So essentially taking money from South Africa, you are taking money out of a very cheap market with a very cheap currency, and you are potentially moving it into an expensive market where the currency has performed exceptionally well already. So yes, there is a lot of noise, but I think a lot of the time we actually just have to step back from the noise and say, well, that's been very helpful in terms of knowing what has been priced in and what hasn't been priced in. And so at M&G, I mean, that's what we've been focusing on for a very long time, is trying to ignore the noise throughout the different cycles and rather just focusing on valuation, what is the quality of the stocks, and essentially that has provided very good performance for our clients over time. That's it from me. Thank you, everyone.